Welcome to Global Unmasked, where we uncover the stories behind the numbers. Today, we dive deep into the tech market crash of 2023 to 2024, a period marked by sharp declines in tech stock valuations, massive layoffs, and a significant shift in the global tech landscape. What caused this downturn? How has it affected businesses, investors, and employees? And what does the future hold for the technology sector? Stay with us as we analyze the key factors behind the crash and explore its far-reaching consequences. The tech market had been on an unprecedented boom in the early 2020s, driven by rapid digital transformation, high demand for tech products and services, and a surge in remote work during the COVID-19 pandemic. Tech giants like Apple, Amazon, Meta, Microsoft, and Google saw record profits, and tech stocks skyrocketed, reaching all-time highs. The rise of artificial intelligence, cloud computing, and other innovations fueled further optimism, attracting massive investments and propelling new startups to unicorn status. However, cracks began to show in late 2022. Inflation was rising globally, driven by supply chain disruptions, increased demand, and geopolitical tensions. In response, central banks, particularly the U.S. Federal Reserve, began aggressively raising interest rates to combat inflation. Higher interest rates made borrowing more expensive, slowing down investments and reducing consumer spending. Tech companies, especially those relying on growth and heavy borrowing, started to feel the heat as investors became wary of high valuations without substantial profits. The year 2023 marked the beginning of a sharp downturn for the tech sector. The Nasdaq, a tech-heavy index, saw significant declines as investors pulled back from high-growth stocks. Companies that had experienced explosive growth, such as Meta, Amazon, and Tesla, saw their valuations drop by 30 to 50%. Layoffs followed, with companies like Google, Microsoft, Amazon, and Meta announcing tens of thousands of job cuts to reduce costs and restructure their business models. The layoffs weren't just limited to tech giants. Smaller startups and unicorns, which had relied heavily on venture capital, were also hit hard. Several factors contributed to the tech market crash of 2023 to 2024. Overvaluation. Tech companies were highly overvalued, with price-to-earnings ratios well above historical averages. When market conditions changed, these inflated valuations quickly corrected. Rising interest rates. As central banks raised interest rates to control inflation, borrowing costs increased, reducing the flow of easy money into high-growth tech stocks. Reduced consumer spending. Economic uncertainty led to reduced consumer spending on tech products and services, affecting revenue streams. Post-pandemic adjustments. As the world adjusted to post-pandemic life, demand for certain tech services, like remote work tools and online services, decreased, impacting companies that had bet heavily on these trends. Before we continue, we'd like to remind you to subscribe to our channel. With 98.4% of our viewers not subscribed, your support helps us bring you more in-depth analysis like this. Hit that subscribe button to stay updated on our latest content. One of the most significant impacts of the tech crash has been on the workforce. Tens of thousands of tech professionals lost their jobs in 2023 and 2024. The layoffs affected not only engineers and developers, but also sales, marketing, and HR teams. Many tech workers are now looking to reskill and pivot to new industries or emerging fields like AI, cybersecurity, and Web3. The wave of layoffs has also sparked debates about the sustainability of the tech industry's hiring practices and its reliance on aggressive growth models. Geopolitical tensions have also played a role in the tech market crash. The ongoing trade wars between the U.S. and China, restrictions on semiconductor exports, and regulatory crackdowns have added uncertainty to the market. Tech companies have found themselves caught in the crossfire, with supply chain disruptions and regulatory challenges affecting their operations and profitability. The global chip shortage further exacerbated the situation, impacting industries from consumer electronics to automotive. While the tech market has faced a tough period, there are signs that a recovery may be on the horizon. The demand for new technologies like artificial intelligence, quantum computing, and renewable energy remains strong. Companies that can innovate and adapt to the new economic realities are likely to emerge stronger. However, the market is expected to be more cautious, with a focus on sustainable growth, profitability, and risk management. Investors, employees, and policymakers will need to navigate this new landscape carefully. The tech market crash of 2023 to 2024 serves as a stark reminder that even the most booming sectors can face downturns. It's a moment of reset for the industry, a chance to rethink growth strategies, prioritize innovation, and build more resilient business models. As we move forward, the tech sector will undoubtedly continue to play a crucial role in shaping our future, but the path ahead will require careful navigation and adaptation. Thank you for watching this episode of Global Unmasked. If you found this video insightful, please like, share, and comment your thoughts below. And don't forget to subscribe to our channel for more deep dives into the stories that shape our world.